Well, let's go ahead and talk about Chapter 4. Turn to page 97 of your book. We're going to talk about job costing. And as you can see here, with the learning objectives, we're going to talk about costing systems, some different types of them. We'll talk about the strategy, the role of the strategy behind product costing, explain how costs flow through a job costing system, and also talk about how we're going to apply factory overhead and what some of our options are to do that in a job costing system. We'll also talk about underapplied and overapplied overhead and what we should do with it at the end of an accounting period. That's mostly what we're going to cover. So we'll talk about then on page 97 why costing systems, and the whole point is to understand if a firm is manufacturing something or if a firm is delivering some kind of a service. The whole goal is to understand what does it cost to manufacture something or to deliver a service. Understanding that and having an accurate number is critical, obviously, right? We have to know how much it costs to make something or perform a service if we're going to charge an adequate price for it and make a profit. Okay, so that's really the whole point behind this. Will helps management estimate costs and accurately charge customers, and of course having an accurate costing system that provides information at the right time to management to make a decision definitely can provide a competitive advantage. That's why many companies spend millions and millions of dollars on these systems so that they can have the best, most accurate data in front of them and make decisions better or quicker than their competition. So we'll talk about developing a costing system, and most of this information is on the bottom of 97 and then also on 98. And there's quite a bit of information on 98 that is important, so be sure to read through that page pretty good, page 98. So product costing is just that general term where we are assigning both direct, remember what a direct cost is, and indirect cost to products or services. Okay, direct and indirect. Direct costs are costs that can be traced to a specific cost object, or in this case, probably a job. Okay, so we know that there's a direct cost. It relates to this specific cost object. If it's a job that we're manufacturing for somebody, if it's a desk, if it's whatever it is that we're doing, we know we can directly allocate that. Okay, everything else then is indirect. And we're going to allocate indirect costs to a cost objects using some cost allocation bases and cost drivers. And we'll talk about those more later during this chapter. Whatever decision a company makes about choosing a system depends on lots of things. What the industry is, what's the product or services that this company is making, the firm's strategy, its information needs for management, and also costs and benefits of acquiring this information or designing or modifying a particular system. Obviously, we can spend millions of dollars to get the best systems available, but we also have to ask, is that really necessary based on our industry, on our firm, our competition, what they're doing, and so on. So you're still looking for a cost-benefit analysis too of how much money do we put into developing a system versus what will the returns be on that system. When developing a product costing-based system, there's three choices that we can choose from. Okay, and now we're also going to talk just a little bit about process costing. We'll cover that later. This chapter is all about job costing. But for us, then, a job is something we're making for a specific customer, something that can be done to specifically assign to an order from a customer, a manufacturer. So think of job costing as somebody orders an airplane from Boeing. That airplane is a job. You take your vehicle to a mechanic to get it fixed. That is a job. You end up in the hospital. You are a job, more or less. Obviously, it would use the term patient or case or something like that. Okay, so a job can be specifically assigned to something. We're keeping track of all the costs associated with that job. Different than what they call process costing And process costings where we're continuously manufacturing the same thing over and over again. Gasoline, like an oil refinery, would be a good example of that. So cost accumulation method, though, we've got three choices that we can make, okay? And we can go with cost accumulation, job or process. We can go then with cost measurement, actual, normal, or standard. And we can go with overhead assignment method, which is volume-based or activity-based. So it's kind of one of those we can choose any of these combinations that best fits our firm, our company, the specific process that we're looking at. We can have all kinds of different options within the same company based on what it is that we're manufacturing or what services we're delivering. It's really up to us. Okay, and we'll get into the nitty-gritties of each one of those here a little bit more. Okay. We'll talk more about the actual, normal, and standard. That's kind of going to be one of the next big ones to talk about here. So the job costing, like I mentioned before, all manufacturing costs incurred or assigned to a job. Okay, so it's a project, it's a specific thing we're doing for a customer. Okay, process costing, homogeneous products through continuous mass production, like an oil refinery. Okay, that's for a later time and date for us. Right now we're going to focus on the job costing. So some industries that use job costing, obviously construction. What does it cost to manufacture a building or build a building? A printing job, special equipment manufacturing, shipbuilding, medical, custom furniture manufacturers, and we're going to use an example with one of them here in the book. But also think of service companies, an advertising agency. You know, if an advertising firm gets an account with a customer, what does it cost to deliver the service of advertising for that customer? An accounting firm would look at a client as a job or a company that you're doing an audit for as a job, same with the lawyer and so on. So it's good for manufacturers and providers of services. Process costing then is, again, those homogeneous products that we're continuously making. An oil refinery, chemicals, bottling companies, many food products, things like that. That's a whole different animal when it comes to accounting, so it's a little bit more complicated. So it's important to understand job costing before you move on to process costing. So when it comes to then measuring cost, remember I said we had three options: actual, normal, and standard. Actual, normal, and standard. And those are on towards the middle of page 98 is where they begin to talk about those. And just be sure that you've read through that, obviously. But then I also want you to understand that the actual system, while it's obviously going to be the most accurate because we're always just capturing all the actual costs, is not used that often. Okay, it says this type of cost measurement is rarely used, and because unit costs fluctuate significantly, thereby increasing the possibility of error in pricing, adding, dropping product lines, we might make bad decisions if we use this system. That's one reason. The other issue is it's not very timely, okay, because we need to capture actual cost, not just direct costs, which are easy to capture, but also all the indirect costs and factory overhead, which take time to accumulate and capture. So when we get to the end of an accounting period, like a year, and if we're using the actual system, it could take months until we've completely understood what our true factory overhead was for the year. Okay, and that means I really can't price my products, or cost my products I should say, until I have all that accurate information. So while it is very accurate, we can make some bad decisions because of cost fluctuations. We might make a bad short-term decision that affects us long-term negatively, and I have to wait a long time to get all the actual data. So a couple of reasons why we don't use it a lot. And so it's much more popular are the other two, normal and standard. Standard we're going to talk about in a future chapter, so we're not going to really talk about it today, and just that just so you kind of know what it is. And we're basically just going to say that we should have a standard cost for everything that we do. So every direct material, indirect material, direct overhead, direct labor, indirect labor, everything has a standard associated with it, both in terms of cost and volume, and we use those standards to help us come up with how much something should cost to manufacture or how much it should cost to deliver a service. And then we evaluate the actuals versus those standards and measure why they're different and what resulted in those differences. That's a future chapter. We're going to focus on normal costing. We're using actual costs for direct materials and direct labor because those are easy to obtain, okay? But then we use what we call a normal cost for overhead because those costs are harder to obtain because I talked about with the actual system, it takes me months to get that information, okay? So normal costing involves estimating a portion of overhead, okay, to be assigned to each product as it is being produced or as a service is being provided. Okay, so that's the key thing. Before an accounting period begins, like a year, we estimate the total overhead for the year, what we think it will be. Okay, and of course, I don't just pull a number out of a hat. I'm using previous history and what I know in order to calculate what I think that overhead will be the next year. Okay, I also have to allocate that, and we're going to allocate that on some kind of an allocation base that we'll talk about later. Okay, so that's part. So we estimate total overhead for the year. That's the numerator, the top part of this formula that we'll look at. The denominator, the bottom part of that formula, is what we'll use to allocate overhead. Okay, and we'll get to some examples of that coming up. So, summary here of developing a cost system and our different methods that we can choose from. This is on the bottom of page 98 again. We've got the three costing systems, actual, normal, and standard. For direct materials, we use actual for actual, normal. For standard costing, we have a standard that we come up with. For labor, actuals and standard. Here's where it's different. For overhead, we look at the actual true overhead, okay? And I've talked about what the challenges are for that. For normal, we're looking at the applied overhead cost, okay, what they call normal overhead cost, something that we estimate before the accounting period even begins. And then for standard, of course, we use these standards that we come up with. Okay, so overhead assignment under normal costing. So again, we're still on normal costing, and now we're talking about how do we assign this overhead? Okay, how do we allocate overhead now? So we're going to accumulate all these overhead items, and then we have to allocate them based on some rationale. We've got two options, volume-based and activity-based. This chapter is going to focus on the volume-based allocation. I should also tell you these are on page 99. It's really where they kind of get into this. Bottom of page 99, the job costing, cost flows, they start to begin to talk about this. Okay, so volume-based costing systems, we're going to allocate overhead using a volume-based cost driver. Okay, so something that changes in volume based on what we are making or what services we're delivering. Okay, and so the examples they give here, direct labor in terms of hours, direct labor in terms of the total cost of that labor, or machine hours. Those are all very easy to measure. That's why they're popular to use. And the theory is overhead costs is incurred to output volume. Okay, and so machine hours, the more we manufacture, the more machine hours we incur. The more we manufacture, the more labor we incur. Okay, so it's all based on volume. Activity-based is a little bit different. Now we're looking at a cause and effect relationship with multiple cost drivers. Some are volume-based, some are non-volume-based. And it's a very accurate system, and it's really looking at different activities that need to be taken to manufacture a product or to deliver a service. And we're measuring what causes each of those activities to happen and how much does it cost for each activity to happen. It's a very refined, very accurate method. We'll talk about it in a different chapter. For us, we're going to focus on the volume-based. The strategic role of product costing. Basically, a few things come into play based on the strategy that will affect the design of a cost accounting system for a company. Okay, is it a commodity cost leadership type of firm? Okay, So a lot of commodity-based firms where you're producing a homogeneous item that's the same thing over and over again, and there really is no way to differentiate your product from your manufacturers. If you think of an oil refinery, gasoline is gasoline, right? You probably don't buy gasoline based on the brand of gasoline. Maybe you do. I'm guessing most people probably focus on cost. What's the rate per gallon? And going from there. Okay. So, I'm buying gas pretty much always based on cost personally. Okay. And sometimes it's convenience. I just happen to be close to a Hy-Vee or Sam's Club or something like that when I need gas. Okay. But if you can think through some ads you've seen for gasoline, like Texaco or BP, they're trying to differentiate their product. It's still a homogeneous product, right? But they're trying to say their gasoline is better because, or they're saying we're more environmentally friendly than the competition, or whatever it is. They're trying to differentiate themselves. Okay, so when it comes to a commodity type product, you need to be a cost leader to make money because your products are all the same, and generally the market sets the price. You have very little control over the prices. The market is really dictating what the price that you can charge is. Okay, so you're focused on being a cost leader. Okay, so that's where it's important. If you're providing this homogeneous product, you want to be a cost leader. That will give you a bit of an advantage over your competition if your system will allow you to be a cost leader. For job costing, though, we're going to be looking at more low volume, highly diversified firms. And so that's more the type of firms produces a wide variety of distinct products in low volume. Costs are easily traced to a job. The book uses the example of a furniture manufacturer. I couldn't tell you how many different furniture manufacturers there are in the country, but there's a lot. Okay, and so for them, they're more focused on trying to accurately cost every job. And if we can know exactly what it costs to make an end table or a couch or a dining room table or chairs or whatever it is, we have an advantage over our competition. We can maybe price a little bit better. We can know which products are most profitable, focus on those, and so on. Okay. Many companies, depending on what they make, could use a combination of job and process costing. Okay. And so for something that's unique, we would use job costing. For something that's very common, we could use more of a process costing. So we can mix and mingle within one company. That's okay. So when it comes to job costing is a product costing system that accumulates costs and assigns them to specific jobs, customers, projects, clients, or contracts. Okay, so we get an order, or we're going to make a batch of something, and we accumulate those costs based on that job. Okay, so again, you and I taking our car to a mechanic, that could be a job. Checking into a hospital because you're sick or need surgery, you are the job. Okay. Those are just some examples. And so what the company needs to do is accumulate all the costs associated with manufacturing the product or delivering the service to the customer. Okay? And so a job cost sheet will do that. It's going to summarize the easy stuff, the direct materials and direct labor, and then calculate using some kind of an allocation rate what the factory overhead should be. Okay? The job cost sheet started when production or the processing of a job begins. So we get an order or whatever it is that starts that job where we can now begin to accumulate costs. We start to do that with this job cost sheet. And they give us a really good example of one. It's kind of small on the screen right there, but the same thing is in your book on page 100. Okay, and you can see it's organized by the three categories: direct materials, direct labor, and factory overhead. And this is for a furniture company, Thomasville Furniture. And in the book they call it TFI, Thomasville Furniture Industries. And we're saying this is the job cost sheet for making 20 end tables. We began this in the future, just a few days from now. We're going to begin this on June 6th. And then we are using job number 351. And we're accumulating the total cost. And then we can take that total cost divided by 20 and come up with what the individual unit cost to manufacture each of these end tables is. Okay, and so you can see that we have 3 different departments that costs are going to run through, and these 3 different departments will all have components of materials, direct labor, and overhead. You can see that we're using requisition numbers, and we'll take a look at one of those, and that will show us what products or what raw materials or parts were used to manufacture that particular those tables in that department before it moves on to the next department and so on. Okay, and you can see that for direct labor, different departments have different rates. Of course, they use different amounts of hours also, and so we're calculating the direct cost with that number, direct labor, and then we're applying overhead, and we're using a departmental allocation. We're saying different departments have a different application rate, $5, $6.70, or $6, and we're taking that times the labor hours. Okay, so the same labor hour number you see here is used again here, and we're multiplying this application rate to get an overhead number, and then adding up all 3 numbers, we get the total cost to make the 20 end tables. So job costing then, the goal here is to calculate, or accumulate I should say, all the cost on this job cost sheet. Okay, after the job is completed, that's when we allocate the overhead. We apply it based on the direct labor hours in this example, and then the application rate per hour. All costs that appear in the job cost sheet need to be recorded in the work in process inventory account, right? So we're debiting work in process and crediting something else. Okay, the total of all active job cost sheets should always equal the debit side of work in process inventory. Okay, if you can recall, a manufacturer has 3 types of inventory accounts. Okay, they have raw materials, work in process, and finished goods. So we're keeping track of the work in process with this job costing sheet. Okay, let's talk about cost flows when it comes to direct materials, and you'll want to be looking at pages 100 and 101 again. All costs recorded on the job cost sheet appear in the work in process inventory. Okay, we talked about that, but we actually have more to think about before we get to that point. Okay, so for our direct materials, of course, we know that we have this materials inventory account, right? So as we are buying direct materials, we're debiting materials inventory and crediting accounts payable, or cash, as we buy these materials. So for everything that we manufacture, we should have what we call a bill of materials, and you'll see one on the bottom of page 101. And it says at the top, bill of materials for a Georgian end table, and it has a style number, has a plant identifier, has the date that this was put together, and we happen to see then what we basically call a recipe sheet. Okay, more or less. In other words, here's what we need to make one of these Georgian end tables. Here's all the different parts and the sizes and so on, like different sizes of boards, the rough size before they're cut, the finished size after they're cut, and so on, to make one of these end tables. Okay, so that's obviously a very critical thing to have if we're going to do this right. Okay. So what we need to do then is somebody needs to requisition the materials, and that's what you see in the top of page 101 is you can see a job number, you can see the department, you can see who authorized this materials requisition, the date, who it received by, who it was issued by, and then you can see the item number. And of course we would need to fill this out completely for every single part needed to manufacture or move from finished goods inventory materials to the work in process inventory number. Okay, so whenever we use this materials requisition number, then we're basically moving dollars from materials inventory to work in process. Okay, and you see some of those journal entries. You see a journal entry that does that on the top of page 102. Also on the top of page 102, you see a very simple journal entry where we debit overhead and we credit materials inventory. And that is for the indirect materials. Basically, the things that we need to use to manufacture these end tables, but the quantity is very small or not very costly in relation to the direct materials, and so we're not spending a lot of money on it, and so it's not a big deal if we don't trace that directly to each individual job. We can just allocate that. And so that could be like glue or nails or screws or something that's needed, but it's not really important that we track every single screw or drop of glue used, obviously. Okay. Here's an example of that bill of materials that's on the bottom of page 101. And then here's that same materials requisition that's on the top of page 101. Okay, so that was direct materials. Let's talk next about direct labor, also towards about the middle of page 102. Obviously, if we have direct labor, we need to keep track of that by job. Any employee who's providing direct labor then needs to track how much time they spend working on a job. And so we'll use some kind of a time ticket, some kind of a system where employees can capture their time and say, I spent this many hours today on these different jobs. So if they're tracking that electronically by punching into a computer or entering a code or scanning an ID or using a time card, just some way to measure the direct labor. Okay, so we're going to accumulate the hours and the pay rate for employees to be able to calculate the labor cost for each job. Indirect labor is kind of everybody else, supervisors, warehouse clerk, just anybody who's needed to support the direct labor, but we cannot say that their time was specific to any job. We have to allocate their time over all the jobs produced. Okay, so basically their salaries go into factory overhead. Okay, just think of it that way. Direct labor goes to work in process inventory. So thinking of debit, that work in process, we're debiting that for direct materials and direct labor. Okay, and factory overhead is used for indirect materials and indirect labor. Okay, so next then is overhead application, and that's probably the more of these three things to keep track of, the one that's the most complicated. So overhead application is the process of allocating overhead costs to a specific individual job. You know, like in this example they show us in the book, this batch of 20 end tables. Okay, and we talked about the actual, normal, and standard costing approaches. Standard costing will be covered later. Actual costing, we talked about that one. Under actual, overhead costs are tracked for each job and are transferred to work in process and finished goods in the exact amounts incurred. The challenge, of course, we know is it's going to take a while to know what that actual is. Okay, so that's one of the downsides with it. Under normal, which is much more common, and that's really what we're going to focus on today. Under normal, overhead costs are applied to various jobs using a single, the key word here is predetermined factory overhead rate. Predetermined, in other words, before the accounting period started, before this next fiscal year started, we got out our binoculars and we looked in the future and we decided, or we're estimating that total overhead will be a certain amount, and then we're going to come up with some kind of an allocation driver, if that's, you know, that direct labor hours, direct labor cost, machine hours, whatever it was, and we're going to take total overhead divided by some kind of an application rate and get this predetermined factory overhead rate. Predetermined, in other words, I'm saying this is what the rate's going to be for the whole year. Okay. So we're estimating overhead used to apply factory overhead cost to a job. Okay. And then every time we assign a job and every time that we apply overhead, this rate, whatever that rate is, times the direct labor hours, direct labor cost, machine hours, we call it factory overhead applied. Okay, so we are applying factory overhead every time a job is completed. There's 4 steps needed to do this, and these steps are on the bottom of page 103. It's probably important you know this. This will make doing the homework much easier. We have to estimate total overhead costs for the operating period, usually a year. Select the appropriate cost drivers that will be used to apply overhead costs. Estimate the total amount of activity for the chosen cost driver. Okay, so the numerator is the top number, the total factory overhead. The denominator then is number 3. For each overhead cost pool, compute the predetermined overhead rate by dividing budgeted estimated overhead for the year by the denominator level of activity for the cost driver in question, if that's direct labor hours, total labor cost, or machine hours, whatever that is. So here it is with the picture, which I think is much better. And the same picture you'll find on the middle of page 104. And you can see then our overhead rate, the predetermined overhead rate, determined before the accounting period begins. Just think of that as a year. Okay, we're estimating total overhead for the year, and we're dividing it by some level of cost driver for the year. Okay, and that cost driver here's 5 examples: direct labor hours, direct labor cost could be one of those, machine hours, number of setups. If we anticipate we're going to make so many batches, each batch needs a setup, number of orders, manufacturing cycle time, whatever it is. Direct labor hours is usually one of the most common ones that we'll see, especially in examples given. Okay, and here it says right here, we can calculate this rate on a firm-wide basis or as on a departmental basis. Obviously, if we compute this for a department, it's probably going to be a little bit more accurate than if we just do it based on the entire firm as a whole. And so on page 104, they show us how to do this for a firm. On page 105, they show us how to do the same thing for departments. And that's really the example that they're giving us with Thomasville Furniture, is when we applied overhead, we had 3 different departments, A, B, and C. Each department had a different overhead application rate, and that they show us how they came up with those numbers on the middle of page 105. Okay, and so we know that we're taking this predetermined rate, right, which is an estimate, and we're multiplying it by actual activity. Okay, so we have an estimated rate. We're multiplying it by actual direct labor hours in the example given to us in the book. Okay, so because we know how many direct labor hours were spent to manufacture those 20 end tables. Okay, so we take the rate that we're estimating times the actual hours to get the overhead applied. Okay, but because we're using an estimate, and we have no other way unless we use the actual method, but the actual method has many pitfalls, I have to do this based on this estimate. Okay, so factory overhead applied to jobs during a period is rarely exactly equal to the actual factory overhead cost incurred, right? If it happened to be equal, it's just pure random dumb luck. Okay, it's almost never going to be the same because there's so many things we cannot anticipate. We cannot anticipate volume, which might affect overhead. We can't anticipate rates, which affects overhead, like how much your insurance might be, how much your actual energy bills will be. We know those things kind of fluctuate up and down. There's lots of unknowns. We can guess. We can do our best to predict the future, but it's really difficult to get it right. Okay, and so a factory overhead applied, so remember, we could do thousands of different jobs in a year, and every time we do a job, when we get done with the job, we apply overhead based on that predetermined rate times actual something, typically actual direct labor hours. Okay, that's how we apply overhead. So it's very easy to over-apply overhead or under-apply overhead. So if factory overhead applied is greater than actual overhead, we've over-applied. If factory overhead applied is less than actual overhead, then we've under-applied. Okay, if the predetermined factory overhead rate is reasonably accurate, both the numerator and the denominator, because we're guessing 2 things. We're guessing total overhead cost, and we're guessing the denominator, which is like the amount of labor hours, or the cost of labor hours, or the amount of machine hours, whatever that is. If both of those are accurate, these will be small differences. Okay, but obviously it's hard to be accurate. Some industries can probably be more accurate than others, but obviously it's almost impossible to get it to be exactly the same. Now I want you to keep in mind that factory overhead is what they call a temporary account. And temporary means that this account has to have a zero balance when the accounting year is over. Okay, So there cannot be a number in this account when we go to do our financial statements. It has to be 0. And so we've got two choices to close out whatever balance is there, either an underapplied or overapplied balance. We've got two choices to allocate it to, or get rid of that number, I should say. Number one is adjust the cost of goods sold account. Okay, we basically just say we're going to either add underapplied or subtract overapplied factory overhead to cost of goods sold. Okay, and so we just basically make a journal entry to transfer whatever's left over in factory overhead to cost of goods sold. Or we can prorate the difference, and prorate means taking some of that difference and applying it to work in process inventory, finished goods inventory, and cost of goods sold. Proration, we'll figure out how to do that in the future. We're not going to worry about it now. You just know that that's an option. So for this chapter, all you have to do is worry about taking that overapplied or underapplied factory overhead number and physically move it to cost of goods sold. Okay. They walk us through that on page 106. Really good stuff there on page 106 that will help you out. And we're going to, and also they talk about potential errors in an overhead application on the bottom of 106 and the top of 107. And the first one I talk about is what they call an aggregation error. An example is the use of an aggregate rate, such as a plant-wide rate, rather than a departmental rate. Obviously, if I have 3, 4, 5, however many departments that are involved in manufacturing a product, it's more accurate if every department has its own application rate. Okay, that's just going to be more accurate than just simply computing one rate for my entire company. So aggregation error, basically just saying a single rate is just not as accurate as departmental rates. Specification error, when the wrong cost driver is used. Okay, so in other words, we chose direct labor hours when a more accurate method of volume or cost would have been machine hours. Okay, so we just didn't use a very good denominator or allocation base. Finally, the measurement error, and basically what happens here is we just had a very bad estimate or bad calculations when it came to estimating total overhead for the year and what the cost drivers would be, with the amount of cost drivers, again, direct labor hours, direct labor cost, machine hours, whatever it is that we're going to use. Okay. Finally, the last thing we're going to talk about in this chapter is job costing in the service industry. They give us that information on page 107. They finish it up on page 108. Job costing, we know, is used a lot in service companies, and just think of any service you've ever had done and imagine how did that company that did that service for you calculate what it cost them to deliver that service. They need to know that if they're going to be profitable, if they're going to be around for a while. If a company doesn't know what it costs to deliver its services, it's not going to price accurately. It's going to either overcharge more than the competition or undercharge and lose money. Okay, so obviously it's important to know the cost of delivering a service to a customer. Okay, and so the cost object then typically is your customer. It's a client, a contract if it's to build something. Typically it'd be a contract or a project that we're building, a project that we're working on if it's like a consultant or an advertising contract, something like that. Major difference is the use of direct materials for service industries may use little or no direct materials. Okay, probably usually none. Okay, or it's so small you don't even worry about it. You just call it indirect or overhead. Okay, direct labor is the biggest driver. Okay, so if you're thinking a mechanic, a doctor, a lawyer, an accountant, a construction crew, you're focusing on people that have to be paid to deliver a service to a customer. So that's the one that's easy to measure. Okay, and so here, because of that, the overhead rate is typically based on direct labor cost, because direct labor is what we're going to mostly incur to deliver a service to a customer. And they walk us through an example of that on page 107. And then they finish up that example on page 108. So be sure to read through that. That'll help you as you do the homework. And that's where we're going to end it. I'm not going to cover operation costing with you. I'm not even going to worry about that. We don't have any homework assignments that cover it either. And same with spoilage, rework, or scrap. I'm not going to worry about those for now. So that'll do it. Hope it made sense. Just be sure to read your chapter. Thanks.